If you've been looking for the moment the market's core beliefs get properly stress tested, well, you found it. Welcome back to the Deep Dive.
It's good to be here.
We have taken the entire stack of sources covering the second full trading week of 2026, what some on Wall Street are calling a super week, and we've boiled it all down into the need-to-know insights for you.
Yeah, this week is genuinely different. We're not just looking at one major event. We have three massive forces all converging at once.
So what are those?
We're talking about the final verdict on inflation, a real health report on the American consumer, and then, of course, the big kickoff for Q4 earnings season.
So our mission today is to navigate that convergence. We want to rapidly pull out the key nuggets that tell us whether the two big narratives driving everything, the U.S. economic soft landing and the very powerful AI bull market, can actually withstand the fire this week.
And that soft landing consensus is, it's holding really tight, but it is sitting on some very high expectations. The sources all show that despite the recent strength in the market, this week is a serious gauntlet. It's either going to reinforce Wall Street's faith or, lead to some major volatility.
Okay, so let's see what momentum we're actually carrying into this crucial 5-day period. Speaking of momentum, we definitely closed the previous week on a bullish note. We saw both the Dow and the S&P 500 hit new all-time high closes. A fantastic finish.
It was a really powerful show of risk appetite returning. The Dow led the indices. It was up over 2% for the week.
Maybe S&P?
S&P 500 gained about 1.6%. The NASDAQ was right behind it. Its gains were a little less, just under 2%.
And the specific engine behind that rally is really key, especially for anyone following the tech space. We're talking almost exclusively about the AI compute supply chain leaders.
Oh, absolutely.
Right.
Nvidia, TSMC, Broadcom, Micron, they were the ones signaling that this faith in, continued exponential growth is still there.
But that AI momentum, as strong as it was, it happened right alongside a major and I think unexpected geopolitical shock.
We absolutely have to talk about that. If you look over at commodities, international oil prices just surged.
Yeah.
Brent was up over 3.7%, WTI up 2.6%. We haven't seen that kind of sharp jump in months.
That's a huge move. And the sources connect this directly to this sudden reintroduction of geopolitical risk. This wasn't an OPEC decision, was it?
No, not at all. It was a direct reaction to the U.S. military action that resulted in the arrest of Venezuelan President Nicolas Maduro.
And the subsequent, large-scale takeover of the country's oil industry by the Trump administration.
Exactly. And what's fascinating here is the market's psychological reaction. Venezuela has one of the world's largest proven oil reserves. So when a major destabilizing government-level action happens there, it just injects immediate uncertainty into the future of global supply.
Regardless of the long-term outcome.
Right. It forces traders to immediately reassess the cost of risk, even while, stock prices are soaring on AI optimism. It's a real split-screen market.
That's a great way to put it. So while geopolitics set the stage for external risk, let's pivot back to that core U.S. macro story everyone is focused on. I'm talking about the job market. Last Friday, we got the December non-farm payrolls report.
And this is where that soft landing story was really tested. The data showed that 2025 had the weakest non-farm job growth since 2003, if you exclude recession years.
Wow. And how many jobs was that for the whole year?
Just about 584,000 jobs, which is, it's a massive deceleration from the 2 million plus that we saw back in 2024.
Logically, a big slowdown in hiring sounds negative. But the crucial insight here is that the market actually reacted positively. Why was that?
Because it perfectly, and I mean perfectly, reinforced that Goldilocks soft landing narrative.
Not too hot, not too cold.
Exactly. The labor market is cooling enough to relieve that wage inflation pressure, but it's far from collapsing. It hit that sweet spot of low recruitment, low layoffs.
So the market got exactly the kind of number it was hoping for. And this was bolstered, I think, by the surprise drop in the unemployment rate to 4.4%, which was a 4-month low.
Right. It basically signaled that the Fed's rate hikes are working. They're cooling the economy without causing a panic, which is really the perfect backdrop for this week's high-stakes inflation report. So with that soft landing expectation pretty much baked in, now we face the economic gauntlet. This week's data is so critical because traders need these reports, the CPI and PPI, to figure out if inflation is cooling enough to push the Fed toward more rate cuts this year.
And the consensus right now is just incredibly firm. There's, a 95% chance the Fed holds steady in January?
Yep. But the market is aggressively pricing in 2 more cuts in 2026, which means any deviation from that expected path could cause some really serious volatility. The market is, as you said, priced for perfection.
Absolutely. So let's look at the first big test. The Consumer Price Index, CPI, for December. That's out on Tuesday.
And the anticipation here is for a significant rebound in the core CPI month over month.
We're seeing forecasts like Morgan Stanley's 0.36% and Bloomberg's at 0.38%. That is dramatically higher than the 0.08% average we saw in the prior 2 months.
It's a huge jump. And if that were true inflation spiking, the whole soft landing story would be in immediate jeopardy.
But it's not, or at least that's not how the market is expected to see it.
Right. This is where we have to pull out that core insight that sort of saves the narrative. The market is widely expected to view this high number as a temporary technical distortion, not a sign of rising underlying inflation.
And why is that? What's the key nugget that lets the market just dismiss such a high number?
It all goes back to the U.S. federal government shutdown period last fall. The agencies that collect all this data, especially for things like rent and owner's equivalent rent, which are super sticky, they had their collection schedules all messed up.
So it's statistical noise.
Exactly. That noise is thought to have artificially pushed down the CPI readings for the last 2 months. So this month's reading is more of a technical catch-up to where inflation actually was, not a new acceleration.
Okay, that makes it far less terrifying. It's a correction, not a trend reversal. So moving upstream from the consumer, we then look at the Producer Price Index, or PPI.
Right, and that'll give us figures for both October and November. PPI is really important because it measures those upstream costs. If factories are paying more, those costs eventually find their way to us.
And the expectation there?
The expectation is that PPI will remain pretty temperate, which is good news for that underlying inflation pressure.
And the PPI also plays a secondary role, right? It's a key input for the Fed's preferred metric.
That's right, the Personal Consumption Expenditure Index, or PCE. We need the PPI data to feed into the future PCE predictions, which is what the Fed really uses to guide its policy decisions.
Then on Wednesday, we get the one that some traders have nicknamed the terror data.
Ah, yes, the November retail sales figures.
Such a dramatic nickname. What makes this data so terrifying for traders?
Well, the nickname exists because consumption pulls something like 70% of U.S. GDP. So if this number misses expectations, it strongly suggests the American consumer is finally buckling.
And that causes immediate panic.
Immediate panic, high volatility in the markets, hence the terror.
Okay, so what's the expectation for November?
The expectation is for a pretty significant rebound of 0.7% month over month.
Where does that confidence come from for such a strong jump?
It's mainly driven by two things. First, a mild recovery in auto sales after that dip from the EV tax credit expiring. And second, and this is the big one, strong online transaction volumes from Black Friday and Cyber Monday. The market is just desperate to see that the consumer is still holding up.
Okay, shifting gears completely now, from the macro data to the corporate world. This week is the official kickoff of the Q4 earnings season, and it feels like a monumental test of corporate profitability.
It's a test of two things at once, really. It tests the underlying health of U.S. companies, and critically, whether that consensus Wall Street view that the S&P 500 will just keep running in 2026 is actually warranted.
I mean, some strategists are even talking about a push toward 8,000 this year.
It's an ambitious target, for sure.
And the banks are the first ones up to defend those kinds of valuations. We start Tuesday with JP Morgan and Bank of New York Mellon. Then Wednesday's heavy hitters, BofA, Wells Fargo, Citigroup. And then Thursday wraps it up with Goldman Sachs and Morgan Stanley.
That's 7 major financials in 3 days. It's just a brutal lineup. The general outlook is positive, though. Goldman Sachs, for one, sees a constructive good outlook for the banks this year.
And what specifically are the growth drivers they're looking for?
Well, the primary one is the sustained recovery in net interest income, NII.
That's their core lending profit.
Right. It's the difference between what they earn on loans and what they pay out on deposits. And after a tough 2024, the expectation is that NII has bottomed and will recover pretty robustly. They're also looking for resilient fees from capital markets and wealth management.
But those banking stocks are already near historic highs. They're priced for perfection in this soft landing scenario. What happens if NII disappoints?
That's the risk. You're spot on. If these giants disappoint, it suggests the lending environment, the deal-making environment, it hasn't recovered as expected. And that immediately casts doubt on the broader economic story. The banks have to show positive operating leverage to justify these valuations.
So if the banks are the soft landing test, then the true litmus test for the AI bull market narrative has to come from Taiwan Semiconductor or TSMC reporting on Thursday.
Oh, TSMC is arguably the single most important company reporting this week for any global tech investor. It's justly called the AI compute supply chain weather vane.
So its performance is essential for the entire AI stock thesis.
Absolutely essential. I mean, companies like Nvidia rely entirely on TSMC's manufacturing capability. So what are investors really looking for in that report beyond just the headline numbers?
I'm guessing it's about demand for the most advanced chips.
Exactly. Sustained, strong demand for the most advanced processes. We're talking sub-3 nanometer nodes. And for its specialized CoWoS and 3D advanced packaging. That capability is absolutely critical for clients like Nvidia, AMD, and Broadcom to meet this explosive demand for AI chips.
So if TSMC signals any bottlenecks or weakness there, that could just shatter the growth expectations for all the U.S. chip designers.
Precisely. We've already seen some confirmation of their underlying strength, though. TSMC's Q4 revenue already came in and it beat analyst expectations. It hit 1.046 trillion NTD, which was at the high end of their own guidance.
And that's why the stock just jumped 6.9% in one day last week, right? After Goldman Sachs raised their price target by a dramatic 35%.
That's it. The market is unequivocally banking on TSMC to confirm that this demand for AI infrastructure isn't just strong, it's still accelerating.
Bringing it back to the overall corporate picture, the aggregate S&P 500 earnings forecast is incredibly optimistic. Analysts are predicting the index will report, 8.3% overall profit growth for Q4?
That's right. And that would mark the 10th consecutive quarter of annual profit growth.
And that growth isn't spread evenly. I think 8 of the 11 sectors are expected to grow, with only industrials, energy, and consumer sectors lagging.
And the consensus from Wall Street strategists is really powerful here. They expect profit margin expansion to turn even moderate revenue growth into double-digit earnings growth for the whole of 2026. This is the single biggest expectation underpinning the entire S&P 500 bull market.
Before we wrap up and synthesize our takeaways, we have to spend some time on the political undercurrents. These are serious risk factors this week. First, the specter of a U.S. federal government shutdown is still there.
That's right. The funding is set to expire at the end of the month, January 30th, so that political clock is ticking very, very loudly. And this risk, it injects immediate uncertainty into the market. A shutdown would disrupt economic data releases, furlough workers. It's a mess.
So what are the sources saying about Congress's ability to avert a crisis this time around?
They're indicating that progress is actually being made. The House has already passed a minibus spending package. It covers key departments like energy, commerce, justice.
So negotiations are moving forward.
They seem to be, yes, despite the tight timeline. If the Senate acts quickly, that market uncertainty around a shutdown could actually start to fade late this week, which would be a nice positive counterweight to all the data volatility.
Okay, the other political risk is judicial, and it's massive for trade policy. We're all waiting on a highly consequential Supreme Court ruling about the Trump administration's tariffs.
Yes, this is a landmark ruling. It's about the use of the International Emergency Economic Powers Act, or IEEPA. This is the act that allowed the previous administration to issue really broad tariffs by bypassing Congress, all on the grounds of a national economic emergency.
So what are the stakes for the market here?
Well, the ruling is effectively going to determine the future balance of power over U.S. trade policy. If the Supreme Court rules against the administration's use of IEEPA, it would significantly limit a president's ability to just impose sweeping tariffs unilaterally.
Which the market would see as a stabilizing force.
For sure. It would be great for long-term supply chain planning and trade relations. But if they uphold the use of IEEPA, it means that kind of trade volatility remains an ever-present sudden risk. And that ruling is expected on Wednesday, January 14th.
Okay, let's unpack this entire super week for you. The market is basically riding on a high wire. It's betting on a Goldilocks soft landing and on sustained AI-driven corporate growth.
And the immediate pressure points are absolutely that expected, but potentially misinterpreted CPI rebound, and then the hard evidence we need from the corporate giants.
Specifically, the banks on the state of the financial environment.
And TSMC on the true health of the AI supply chain.
And this knowledge is so vital because these are the data points that inform that consensus view that the U.S. economy is going to grow faster than expected in 2026, a forecast, heavily boosted by institutions all across Wall Street.
Understanding the stakes this week really means understanding where global capital is going to be deployed.
It does.
And here's the final thought we want to leave you with. The sources consistently point toward a target of double-digit earnings growth for the S&P 500 for 2026. Now, that level of profit growth should absolutely drive stock prices higher. But that entire forecast depends on one very crucial factor: maintaining near historic peak valuations.
Which raises the essential question for you to think about. If those strong earnings numbers are confirmed by the banks, by the tech leaders, but macroeconomic shifts or, say, political shocks cause market valuations, those price-to-earnings ratios, to slip from these record highs, will the current bull market faith be enough to sustain the S&P 500's ambitious journey towards 8,000?
That's the multi-trillion-dollar question, something to mull over until our next deep dive.